Protect your wealth. That's the goal behind capital gains crystallization, locking in today's tax treatment so tomorrow doesn't cost you more. Here's the quick version. A capital gain is the profit when you sell an asset for more than what you paid after costs. In Canada, only a portion of that gain is taxable. This is the inclusion rate. Then versus now, for years, half your gain was taxable. After June 25, 2024, the inclusion rate effectively increased to about 2/3, 66.67%. That increase applies on capital gains above $250,000 for individuals. It applies to all gains for corporations and trusts. Gains at or under $250,000 for individuals still use 50%. Translation: timing matters. Crystallization means I intentionally trigger a gain under rules I like, often when rates are lower, or when I can use exemptions, then reset my adjusted cost base to today's fair market value. That reset can shrink future taxable gains. Why do this? 3 big reasons. Lock in a lower inclusion rate on gains I already have. Use the Lifetime Capital Gains Exemption, LCGE, on eligible qualified small business corporation shares. Align with succession or retirement plans while staying compliant. The LCGE is powerful. There's a lifetime limit, recently increased to $250,000 for QSBC shares, letting me shelter eligible gains entirely. But eligibility is strict. QSBC Basics I watch. At sale, 90% plus of company assets must be used in an active business in Canada. For the 24 months before sale, 50% plus must be active. Ownership tests apply. Generally, I need to hold the shares for at least 24 months. If I've got excess cash or passive investments, I may need to purify the company before crystallizing. Quick math to feel the difference. Say I've got a $1,000 gain. At 50% inclusion, $500,000 is taxable. At 66.67%, $667 is taxable. That's $167 more taxable income after the change, before I even apply my marginal tax rate. A simple playbook I consider. 1. Map my assets, cost base, fair market value, and unrealized gains. 1. Sort eligibility. Are any shares QSBC? Do I meet 24-month and asset purity tests? 1. Choose a method, outright sale, a deemed disposition, or a rollover using tools like Section 85 elections during reorganizations. 1. Use exemptions. Apply LCGE where eligible. Coordinate with losses and deductions. 1. Plan cash. Crystallization can create a tax bill. Set aside liquidity. 1. Document and file. Report accurately and reset my adjusted cost base. Cautions: markets move. Crystallizing in a high valuation window can lock in a higher cost base. Don't jeopardize QSBC status with passive assets. Coordinate with estate freezes, trusts, and corporate structures to avoid surprises. Bottom line, crystallization is about control. I can trade a known tax outcome now for less uncertainty later, especially when rates rise. If I hold QSBC shares and qualify for the LCGE, the savings can be transformative. Protect your gains, plan your timing, and align it with your bigger life goals. That's how I keep more of what I've built.